In mining, many companies talk about growth. More tons, more projects, more resources, more production. But sometimes the most important question is not how much a company can produce. The real question is how much cash that production can generate for shareholders. That is why Amerigo Resources is such a different copper story. Amerigo does not operate a traditional mine. It does not explore for new deposits. It does not need to build a new mine from zero. Amerigo produces copper and molybdenum by processing tailings from El Teniente, the largest underground copper mine in the world, operated by Codelco in Chile. In other words, Amerigo is not a classic miner. It's more like a copper factory. It takes material that already exists, processes it through the Minera Valle Central, and turns that material into copper, molybdenum, and cash flow. And the most important part of the story is that Amerigo has designed the company to return that cash to shareholders. This is why the current moment is so interesting. Amerigo has eliminated its debt. It has increased its base quarterly dividend. It has paid a large performance dividends. It continues to buy back shares. And the copper price has pushed the stock close to record highs. So the question today is not longer only what is Amerigo. The real question is what changes now that Amerigo is debt-free, copper is strong, and the company's shareholder return strategy is working at full power? Let's start. Welcome, mining lovers. This is Charlando de Minas, the Spanish podcast dedicated to mining investment, now in English. Do you want to learn? Subscribe. Do you want more content in English? Leave us a comment. The episode is about to start. Welcome to Charlando de Minas, the only Spanish podcast dedicated to mining investment, today in English. This is a summary of the original interview in Spanish to Amerigo Resources. If you want to watch the full original interview with Aurora, you will find the link in the description and the comments below. Today, I bring you the English summary of the new interview with Aurora Davidson, President and CEO of Amerigo Resources. This is not a literal translation. The goal is to organize the conversation and explain why Amerigo is attracting more attention from investors, what has changed in the company, and what shareholders should watch from now. This was the third time that Aurora came to the podcast, so the interview was not the first introduction. It was more like a continuation of a long conversation. Over the last years, Amerigo has explained the same idea again and again. This company is built to generate cash and return that cash to shareholders. In previous interviews, the company was already a cash flow and shareholder return story. Amerigo had recovered from the climate issues of 2023, production had normalized, and the company was producing copper and molybdenum at competitive cash costs, and the main topic was the capital return strategy. That strategy has three tools: a base quarterly dividend, a performance dividend linked to the excess of cash generation, and a share buybacks. At that time, one major milestone was still pending: eliminating the debt. Amerigo said that once the debt was gone, more cash flow could flow directly to shareholders. So today, that has happened. The company is debt-free, the base dividend is higher, the performance dividends have been paid, and buybacks continue. So the natural question is, has Amerigo delivered what it promised? According to Aurora, the answer is yes. More importantly, the market is starting to understand the model better. Of course, the copper price helps. When copper is strong, investors pay more attention to copper companies. But Aurora, she said that the share price performance is not only about copper. Amerigo has not changed radically. It is still the same company. one asset, low capital intensity, stable operations, and a strong cash generation. The difference is that the market is now evaluating these qualities more than before. In a volatile world, investors are start to appreciate companies with operational visibility, controlled costs, and clear capital return policy. Amerigo is not a story of growth at any price. It is a story of a stable production, low capex, and cash returns. This is why Aurora uses the expressions copper factory. Amerigo is a copper factory that works, generate cash in a predictable way, and returns capital to shareholders. This is more important for valuation. One concern investors may have is simple. Has the stock already gone too far? Has the stock already peaked? Aurora's answer was also simple. She believed that the market still does not fully reflect the company's ability to return cash. Amerigo said that paid a base quadrennial dividend for 19 consecutive quarters. That base dividend alone represents a yield around of 3%. But on top of that base dividend, Amerigo has a flexible layer, performance dividends and buybacks. In the first quarter of 2026, the company showed what can happen when there is an excess of cash. If we include the dividends already declared this year, shareholders have received a dividend yield of more than 7%. This is a very important number. Aurora explained that this 7% does not assume future performance dividends that has not yet been declared. It only reflects declared performance dividends and the base quaternary dividend. In her view, if a business as stable as Amerigo is offering a yield like that, the share price might still not be fully recognized the cash return capacity of the company. Her view is that over time, if Amerigo continues to return capital consistently, the market should normalize the yield through a higher share price. In other words, Amerigo is not only a copper price story, it is a cash flow story. That also explains the change in the shareholder base. For many years, Amerigo's main shareholders were retail investors. Many of them understood the business very well and supported the company for a long time. But after the strong rise in the share price, some of these investors reduced their positions. Aurora explained that this was not necessarily a negative signal. In many cases, these investors had made large gains and simply need to rebalance their portfolios. At the same time, institutional capital is starting to enter. One key event was Amerigo's inclusion in the COPEX ETF in April 30 of 2026. That matters because COPEX is one of the global reference ETFs for the copper sector. Once a company enters into ETFs like this, it becomes a part of the structural copper universe for many investors. This can bring mandatory buying, more stable long-term ownership, and more visibility among global copper investors. For Amerigo, this is a very important step. It means the conversation is changing. Retail investors might focus more on copper price movements or short-term headlines, but institutional investors tend to focus more on predictability, cash generation, capital allocation, and long-term structure. And those are exactly the things that define Amerigo Resources. So, the company has not changed. What has changed is who is looking at it and with what time horizon. The interview also touched on volatility. Amerigo's share price has moved a lot, but Aurora does not see this as something specific to Amerigo. She sees it part of the broader macro and geopolitical environment. There has been volatility in copper, in markets, and investor sentiment. However, the company does not feel directly exposed to some of the risks that have concerned investors. For example, some investors ask about the sulfuric acid prices or supply risk. Amerigo does not use sulfuric acid. El Teniente does not it either in a way that affects Amerigo's operation, so that risk does not apply directly. DSL is another question. DSL prices increased sharply in Chile after geopolitical tensions with Iran, but DSL represents only around 5% of Amerigo energy supply. The estimated impact is around $1 million per year, so it's not irrelevant, but it's manageable. Aurora also said that they have not seen major concerns about Chile as a jurisdiction. There is always global market noise, but there has not been a direct operational impact on Amerigo. This leads to another key question. If an investor discovers Amerigo today, after a strong share price increase, is it too late? Aurora's answer was clear, not necessarily. The share price has gone up, but the business is now more proven. A new shareholder is not entering a speculative exploration story. They are entering a company with known costs, low capital intensity, visible quarterly returns, and a clear shareholder return framework. That is the key point. Amerigo is not mainly a story about share price momentum. It's a story about cash generation. And Aurora believes that this cash generation is not fully captured in the share price. Operationally, 2025 was also important because it tested the business. During the year, El Teniente suffered an accident that affected the supply of fresh tailings to Mireia Valle Central, and for several days, Amerigo did not receive fresh tailings, but companies continue operating by processing historical tailings. This is one of the key strengths of the business model of Amerigo. Amerigo has flexibility. It can process fresh tailings and historical tailings. So when fresh tailings were interrupted, the company did not stop completely. When El Teniente restarted operation, first partially and later normally, Minera Valle Central returned to receiving fresh tailings without operation friction. Despite this disruption, Amerigo produced 62.2 million pounds of copper in 2025, above its reserved guidance. Molybdenum production reached 1.5 million pounds, also above guidance. Aurora described 2025 as a test year. The company had to prove that it could deal with a disruption outside its control, and in her view, Minera Valle Central passed the test. The operation showed flexibility, redundancy, and the ability to absorb shocks without losing the rhythm of the business. This matters because some mining operations need everything to go perfectly in order to meet guidance, and Amerigo showed that it does not need perfect conditions to deliver. Another important topic was recovery. The fourth quarter of 2025 was not only a catch-up quarter after El Teniente accident, it was also supported by better recoveries. Aurora explained that two optimization projects were completed in 2025. The first was an optimization in the classification stage of the regridding circuit, completed in September. The second was an optimization in the cascade flotation stage, completed in November. These were not radical redesigns of the plan. They were small improvements designed to increase process stability, but in a mature operations with large volumes, small improvements can have a big impact. The regridding classification project increased recovery in that stage by around 4% and reduced particle size variability. That helped both the copper and molybdenum circuits and was one of the reasons why molybdenum production was strong in 2025. Aurora made an important point. Amerigo is not expecting a technical revolution. The plant is already operating at high level, but there is still room for small, sustained improvements. The opportunity is not to completely change the plan. The opportunity is to reduce variability, adjusting parameters, and improve stability. That is the kind of optimization Amerigo is focused on. For 2026, the guidance is 63.8 million pounds of copper and 1.5 million pounds of molybdenum. The first quarter started well with 14.3 million pounds of copper and 0.32 million pounds of molybdenum, and a plant availability of 98.5%, and a cash cost below an annual guidance. This was achieved even though the company completed its annual maintenance during the quarter. Does that mean that 2026 guidance is conservative? Aurora prefers to say it differently. She said that the guidance is not conservative by reflex, it is responsible by design. Amerigo builds its guidance and detailed work during the previous year. The company is not trying to guide the highest possible level that the plan could reach. It is guiding to a level that is repeatable and defensible across a full year. So, when results come in above guidance, it does not mean management is hiding potential. It means the business executes better than the prudent scenario. Aurora summarized it well. Amerigo guidance is low in drama and high in credibility. On cost, 2025 cash cost was around 1.93 per pound. For 2026, guidance is around 1.98 per pound. Aurora said that no major structural cost issues worries her. The main source of variation are external: Chilean power pass-through charges, diesel, inflation, and the exchange rate between the Chilean peso and the US dollar. The stronger Chilean peso is especially important because many local costs are in pesos, while Amerigo reports are in US dollars. Historically, when copper prices rise, the Chilean peso can strengthen. That can put pressure on local costs when translating to dollars. But again, this is not a structural problem. It is part of the cost sensibility of operating in Chile. Amerigo also provides sensitivities in its guidance, so investors who model the company can adjust for molybdenum prices, copper prices, exchange rates, and other variables. Molybdenum was another important contributor in 2025, but Aurora was clear: molybdenum helps, but the business should not depend on high molybdenum prices. Amerigo has produced molybdenum since 2005, so it is part of the model. But internally, the company managed cash costs excluding the molybdenum price effect. Why? Because if molybdenum price rises, reported cash costs look better, but that might not reflect better operating performance. And if molybdenum prices fall, then opposite happens. By excluding the molybdenum prices from internal KPIs, management keeps the business honest. Molybdenum is useful by product credit, but the operational must be strong without relying on the lack of molybdenum prices. Then we came to the heart of Amerigo thesis: shareholder returns. Since the start of the capital return strategy in 2021, Amerigo had returned more than $114 million to shareholders and reduced the share count by almost 15%. In 2025, the company returned more than $20 million, reduced the number of shares, and eliminating its debt. In the first quarter of 2026, with copper near record levels, Amerigo declared its largest performance dividend ever, 16 cents per share. By eliminating was a major milestone. According to Aurora, it does not change the core strategy, but it makes the strategy clear and more powerful. Before, part of the cash had to go to creditors. The company was paying around $7 million per year in principal and $2 million in debt service. Now that the debt is gone, that cash flow can go to shareholders. In Aurora's word, there is no longer a difference between free cash flow and free cash flow to equity. There is a simply free cash flow. This allowed Amerigo to increase the base dividend by 33% in October of 2025, from 3 cents to 4 cents per quarter. Aurora explained that this increase was a structural decision. Amerigo is conservative with the base dividend because only it raises the base dividend, it does not want to cut it. The current level is the one that the companies believe it can sustain even in more conservative copper price scenarios. For 2026, the company does not expect another increase in the base dividend. Instead, excess of cash will be returned through performance dividends and buybacks. That gives Amerigo flexibility. It can return more cash in a very strong periods without creating a permanent commitment. Buybacks remain another important tool. The minimum goal is to avoid dilution, but in 2025, Amerigo went further and reduced the share count. Aurora said that in 2026, further net reductions are possible if excess cash is generated and if the share price still does not fully reflect the company's cash return capacity. But the company will not promise automatic buybacks. The board decides based on capital allocation, market conditions, and the best use of cash. Amerigo had also approved a higher capex program for 2026, around $17.5 million. This is higher than previous years because the company is investing in optimization projects. Does this compete with the shareholder returns? Aurora said no. These projects have limited capital requirement, fast paybacks, and are based on copper price of $4.8 per pound. The longest payback is less than 2 years and some are measured in months, so the goal is to improve free cash flow and operational reliability. In other words, the capex is not competing with the capital return strategy, it is supporting it. Amerigo is not spending money on large speculative projects. It is optimizing an operation that already works well. The company also said that it does not have a major new risk mitigation project in 2026. That it's because many of the main physical risks have already been addressed in previous years. The operation is well maintained and risk management is now part of sustaining capex and day-to-day discipline. So, what should investors watch over the next 12 months? Aurora gave 3 main indicators. First, operational consistency. Investors should watch copper production, molybdenum production, and whatever the company stays within guidance. Second, cash flow generation through cost control. The key number is cash cost. In a business like Amerigo, cash cost tells investors a lot about whatever production is turning into real cash. And third, capital allocation discipline. Investors should watch whatever Amerigo continues doing what it says it will do, run a low capex business and return excess cash to shareholders in a transparent and consistent way. So, what is the conclusion? Amerigo is not longer a debt reduction story. That's a milestone that is complete. It is now a pure cash return story. The company has a stable operation, low capital intensity, controlled costs, no debt, a higher base dividend, performance dividends, buybacks, and growing institutional visibility. The business is not risk-free because it is still exposed to copper prices, costs, operational performance, and macro volatility. But compared with many copper companies, the model is simpler, more predictable, and much more focused on shareholder returns. Amerigo is not trying to be the fastest growing copper company. It is trying to be one of the most disciplined copper cash flow companies. That is why the story is interesting. If company remains strong and Amerigo continues executing, the shareholder return can remain very attractive. But even more important, the market might continue to understand that Amerigo is not just another copper stock. It is a copper factory designed to convert production into cash and cash into dividends and buybacks. For investors, the key is not only to watch copper price, the key is to watch whether Amerigo continues to deliver stable production, controlled cash costs, and disciplined capital returns. That is the Amerigo thesis. Simple to understand, but very hard to replicate. Disclaimer: the content in Charlando de Minas is not an investment advice. Amadeu Bonet and his guests are not investment advisors. The authors may have interest in the companies mentioned in this publication. They may also have bias and not be impartial. The information in this publication and all the others in Charlando de Minas is impersonal by nature and should be considered as an entertainment product. The minimum risk of any investment mentioned in this video is 100% of the capital. Before to make any investment decision, contact a financial or investment advisor or someone qualified with experience. These broadcasts are a narrative of my learnings in the world of commodities and mining investment. In this podcast, we will try to bring experts, professionals, and companies. If you like it, please subscribe. I am Amadeu Bonet. Welcome to Charlando de Minas.